difference between talking to a lender that can barely spell self-employment versus talking to a lender that's got 25 years of experience. All right, so let's talk a little bit about self-employed borrowers. More complex, and not necessarily more difficult, but I think that there's some uncertainty around self-employed borrowers because they tend to not get approved as easily or as often than maybe somebody who's employed and has a simple pay stub and W-2 and stuff. So far as, self-employed borrowers, I think that they get told no more often just because the lender doesn't have a strong understanding of how the income is structured. So usually the first question is usually like, how do you report your income to the IRS? And it's going to be maybe a simple Schedule C, could be a partnership with a 1065, could be an S Corp, like an 1120S, could be a C Corp. Those all play important roles because it means what kind of documentation we're going to be requesting, as far as business tax returns and K1s, what it's going to look like on your personal returns, whether you're a 100% owner or you're, a percentage owner with some other people. So just discussions about how you report the income to the IRS normally helps decide the structure on it. Now, if ultimately that your income is not going to be supportive of the income you need to qualify, well, then you may not even choose to present them. But I think it's always a good idea to at least let the lender review your personal and business tax returns so they can evaluate them. The truth is, every lender is required to evaluate them all the same way. FHA and VA have slightly different underwriting guidelines, but conventional with Fannie Mae and Freddie Mac, they're pretty similar. So every lender is supposed to be doing it the same way. And I think that it's just too complicated for a lot of lenders, or maybe they don't know what to ask. Maybe they're embarrassed that they don't know how to help that borrower, so they just tell them no, because no is an easy answer, right? You'll never be wrong with telling somebody no, but you're missing opportunities and you're missing being supportive and being a good strategic partner with your referral source and helping that self-employed buyer get the money they need to buy the home they want. Bank statement loans are usually an alternative to tax returns. If your tax returns are toxic, they're not going to work, don't even worry about it. Let's just say they're not eligible. Your bank statements typically can show cash flow. And so usually lenders can do business bank statements if that's where you put all your deposits, or it could be personal bank statements, but you need to provide typically the last 12 months. Some lenders can do it with 6 months. Some lenders can do it with 3. I will say that the fewer number of months that you provide, the less attractive the terms are going to be, in regards to down payment and maybe interest rate. If you want to go ahead and produce 24 months, then you're going to get a little bit better on the interest rate. But generally speaking, about 12 months is what's going to happen. And so if it's a business bank statement, usually the lender is going to say, okay, all of the deposits that are business deposits, we're going to divide by 2, or essentially give the business a 50% expense ratio. And then the other 50% deposits are going to be yours. If you're a 100% shareholder or owner, then those deposits are yours. If there's more than one owner, hopefully both of those owners are going to be on the home loan, so you can use all of those deposits. If you start getting into situations where there's multiple owners, sometimes the lender won't even use those bank statements because you as the borrower are a minority owner, and so it's not really going to be eligible for repayment income. Or you could use your personal bank statements. Typically they'll take all of the deposits in your personal bank statement, and you can even blend those with maybe a W-2 borrower. Let's say a spouse has a job as a W-2 person and you're the other borrower and you're self-employed and everything is in your personal bank account. You could actually use the deposits for the spouse and yourself, and that could be a great way to come up with cash flow. So bank statements are a great way to help a self-employed borrower. If you've got really good credit scores and you're putting money down, believe it or not, the interest rate is probably going to be very similar to a conforming A-paper rate. There's not much difference because everything's still being validated. Write-offs. Write-offs are a big part of somebody who's self-employed, right? Because if you're self-employed, you're going to try to expense every single piece of money in order to reduce your taxable income to the IRS. And when you come to somebody like me as a lender and we're starting to look for a qualification income, we're looking for stable, predictable, likely to continue income. And typically the only income we can use is income you pay taxes on. So if you're expensing all of these legitimate eligible expenses, you could be pulling down your repayment income. So your qualification income might be a lot less than what your actual monthly income is you receive. So it's good to talk to your lender about the structure of your current year. So right now it's tax time. People are getting ready to file their 2025 tax returns. This would be a good time to talk to your lender and say, okay, discuss what type of income do I need in order to be able to qualify for a certain price point. If you've been self-employed for 5 years and we can prove it, usually there's a way for us to just use 1 year of income tax returns. So follow me on this. Here's a little trick. If let's say 23 and 24 were tax returns that didn't support the sales price of the home that you wanted to purchase, but you knew that you were eligible to use 1 year of income, it would be a strategic advantage for you to talk to your lender and do this in cadence with them. Have your returns for 25 prepared, have the lender review them, and determine if that's going to be an eligible repayment income, like your qualification income, so you can make a decision. Hey, for the year 2025, we may not claim as many of expenses, or we may not write off as much stuff because it's more important for us to be a homeowner than necessarily for us to save money on our IRS taxes. Instead of you being denied for your home loan, that's why it's important to talk to your lender about your repayment income, specifically if you're eligible for 1 year. Sometimes we need the 1 year with the last year's to average. Sometimes it's just a matter of tweaking the current year's income and filing those and being strategic about it. Some loans get denied just because the lender is not guiding the home buyer. That business tax returns, there are usually eligible expenses, meaning that there's things that we can add back to the income. So what I mean is, sometimes there's depreciation. That's a paper write-off, right? That's not an actual expense. That's because you're depreciating an asset that's owned by the company. That lowers your taxable income to the IRS. We can add that money back to your repayment income. And more importantly, usually the business is paying for expenses that might be reported on your personal credit report. I see this a lot with vehicles, right? This is a company work truck. The company makes the payment. The company expenses it on the returns. We can exclude that from your required debt to income ratio. And so just by discussing the framework of the company, what does the company pay for, which expenses are paid for, you would need the most recent 12 months of business bank statements to show that the business actually made the payment on the vehicle, and you would need to identify on the tax returns where specifically the business took that deduction. They would need to be writing off the expense for that vehicle. If you can do both of those, you can generally exclude that debt from the borrower from your actual debt to income ratio, and that's a great way for you to turn from being a denied loan to an approved loan. A lot of lenders don't do the due diligence to review the income and actually evaluate the income, and then look at expenses and start to evaluate and analyze that. That's the difference between talking to a lender that can barely spell self-employment versus talking to a lender that's got 25 years of experience helping complex loan approvals get done. And then the last thing that's pretty cool, so if your tax returns aren't going to work, but you get paid with the 1099, as long as you've been paid with a 1099 for a year, you can usually use that 1099 as your gross income. Now, you may not get the best interest rates and you may not get the smallest of down payment, but that's another opportunity for you to at least, here's my cash flow, right? Similar to a bank statement, but it's better. It's like, here's the source of my income. Here's how much income I earned for last year, and we can use that as your effective income. Now, you might have to put 10, maybe 20% down, but at least you're going to have an income that you can use, and you're not actually having to present your tax returns. So just because you're self-employed doesn't mean that you don't get a loan. You just need to talk to a lender that understands self-employment and has alternatives with non-qualified mortgages, using bank statements or 1099 programs, or better yet, just doing the tax return evaluation the correct way. So if you want more information about self-employed, or you have questions around being self-employed, be sure to like, comment, and share, and comment below, and I'll be happy to help.